Not much has changed since our video of last week. We're still facing resistance. If you haven't seen that video, it may be worth tracking down and helpful to your planning in the next few weeks. In today's video, we'll quickly cover the current chart of the S&P 500 futures from a DeMark perspective. Then we'll look at a similar chart for the S&P 500 index, and we'll end with a potentially interesting and bullish signal on the chart of the S&P 500 relative to TLT, the long-term Treasury ETF. The signal is similar to what turned out to be a bullish signal in October of 2004. Time permitting, over the next week or so, we will try to provide updates on our blog, short takes, and via Twitter. It's Wednesday during the trading session. It's roughly 12:25 on the East Coast. We're looking at a DeMark chart for the S&P 500 futures. DeMark charts and indicators are proprietary tools from Market Studies LLC. Just a few points here before we get to the risk-on, risk-off ratio chart that has a signal similar to what turned out to be a bullish signal in October of 2004. We have here, this is what's known as a DeMark TDST line. This is a TDST low here. When this line became bolded right here, that's what's known as a qualified bearish break of support. And in DeMark speak, it's indicative of a trend change. So this is a bearish shift here. And you can see, like a lot of DeMark signals, this turned out to be an excellent signal. The stock market went down from May 11th all the way to the low in early June of 2012, June 4th. This is bearish. Here's the similar TDST line, but on the bullish end of the spectrum, this is a TDST high, and on the futures, it sits at 1396.25. You can see intraday, this line is bold. It represents a qualified bullish break, which is similar to this qualified bearish break. Here the trend accelerated in a bearish manner. If this holds, the probability would be that we would accelerate in a bullish manner. I want to emphasize this is intraday. This may not be bold at the end of the day depending upon where we close. We also intraday have what's known as a perfected sell setup, which is similar to this 9 and this down arrow here in red. You can see sell setups can lead to reversals, but not always. Here we got a perfected buy setup, but we were already in a strong downtrend, and the market continued and actually continued to get a 913 on some of the DeMark counts. So here, to get the 9 sell setup, we would have to close above the close on the 5 bar, which is 1400.50. So just a little bit over 1400 and change on the futures. We would have to end today's session to keep this 9 and a down arrow. So the most bullish scenario would be that if this line is bold at the end of the day today, the most bearish scenario would be that if the S&P 500 futures finishes the session above 1400 and this becomes non-bolded by the end of the day. If that happens, the probability of pulling back towards these yellow propulsion targets like we did here, 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 and here would probably increase. The current propulsion target is hard to see there, but you can see this level here. It's 1370. Typically, we've gone 15 points below these yellow propulsion targets on pullbacks, which would take you to roughly 1355 if we pulled back towards this target. That also starts to bring you back to another potential area of DeMark support, which would be here at 1360. This line here is similar to this line here. Support didn't hold in this case. Moral of the story, if this holds, this is potentially bullish similar to this bearish break in the other direction. So this would be a mirror image of this line here. If this 9 holds, it would increase the probability of a short-term pullback even within the context of an existing uptrend. If we get a pullback and we remain above 1360, 1355-ish, 1370, 1365-ish, that would probably represent a buying opportunity and potentially a place to cover any hedges that you may have. If we break below this level into this area here, then the bears would begin to pick up steam. A break below this level, which is 1330 and change, would really improve the bearish case. For now, we have an uptrend. Every comment that we made on the previous chart applies to this chart. This one is just the S&P 500. The previous chart was the futures. Everything's the same. Have the qualified break intraday. I want to emphasize that. Qualified bearish break here. For this 9 down to remain in place, we would have to get a close today on the S&P 500 above 1402.80. That's 1402.80. If we close below 1402.80 today, that would erase this entire count and just negate it. So this chart would basically be blank here tomorrow. It would take away all of these numbers and it would look similar to this. If we do get a pullback on this chart, your downside targets within the context of an uptrend, you might get support at 1365. And if you wanted to look at the propulsion targets on here, the yellow lines came back down below them, below them, below them. The yellow propulsion target potentially where momentum would still stay in a bullish camp if you reversed is at 1371. If we break these levels here, then 1332 starts to become realistic relative to where we could get a counter trend rally. A break of this would start to question the uptrend. A break of this would also question the uptrend in a similar manner to this point here. This is a chart we showed last week. This is the ratio of the transports, the IYT ETF to XLU. Just revisiting it. Last week we said we had a perfected buy setup on this ratio, and we said that the last time we had a 9 and an up arrow in a similar manner was back on this date here, which was March 9th of 2009. And as you know, that was the low in the stock market, and a big risk-on rally followed. If this holds and this ratio moves in this direction, it would be bullish for both stocks and commodities. Now let's look at the ratio of the stock market, SPC5 in this case, or SPY to TLT treasuries. This is the DeMark chart for the S&P 500 relative to long-term treasuries, or the TLT ETF. These are weekly charts that we're looking at. The point that we want to make here, and this is the same ratio that we looked at or wrote about in the Wednesday, August 15th post on our blog, Short Takes. What we have here is the ratio of risk on to risk off. When the ratio is rising, this is bullish for risk. When it's falling, it's bearish for risk. You can see the ratio started to rise here near the point where the stock market bottomed in October of 2011. What we have now is a perfected buy setup on this ratio, and we also have a clear trend change following the buy setup. So we've got a trend break here, a higher low relative to this low, and then we went on to make a higher high here. This is an uptrend that's in place. When was the last time we had a similar situation with a 9 up on this ratio where the market reacted in a bullish manner? The answer to the question is 2004. Now we're looking at the exact same chart, just going backwards. This is January of 2004. Here's where we got the perfected buy setup. You get the 9, it's when the arrow comes in is when it's perfected. And that date here is October 18th of 2004. In the short takes post, we show a chart of the S&P 500 where we highlight October 18th of 2004. The stock market from October 18th of 2004 until the peak in October of 2007 gained roughly 40% after this risk-on signal was given in October of 2004. So does that mean that we believe the stock market will gain 40% from the recent lows in June of 2012? No, we don't believe that, but we believe this is potentially another in a series of potential risk-on signals relative to risk-off. And the last time that this buy setup was given in this manner, where we had a 9, an up arrow, and a market that reacted to it, the stock market did very well relative to the bond market. Doesn't mean it will happen again. It probably increases the probability of good things happening in risk relative to risk off in 2012. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.